Hi, welcome to the Market Alert for Monday, the 30th of March 2020. So on Friday, we can see that stocks soar to best week since the 1930s as the dollar and bond yields crash, even though the Dow was down 900 points in the final 10 minutes of the session during Friday. So let's have a look at this first before we get into a few other things. So here we've got the daily chart of the Dow, and I've put a few fibs on here now just to show you or give you some sort of targets of where the market could move to. You can see that the first downward leg of the market retraced to 50%, which you can see here, which is just by the 200 MA there. Market closes back below the 5-bar moving average, having closed back towards the 50-bar MA, and then the market moves lower until it closes above the 5-bar average there. So the market remains short all the way down here, with prices failing to close above the 5-bar moving average. They've since done this and remain above it. However, overnight prices have gapped down and are now trading back to the 20-bar moving average and the 50% fib retracement there. So it'll be interesting to see if the market can make it back to this level. And given the fact that they've now printed 2 trillion and added this to the Fed's balance sheet, which we'll come to in just a moment, I wouldn't be at all surprised if they don't attempt to bring this market back as far as they can before the next wave of selling, which could be next month. But at the moment, there seems to be a lot of motivation, financial and otherwise, to bring the markets back. So watch the 200 MA. Also note the fact that the market's gap below the 5-bar moving average and is currently moving to the upside there as well. On Friday, we see the market move lower, retraces back, and then you can see what I've done here is added all of these fibs in to show you where the market's come back off its up and down move there, which you can see. And then eventually, as it made all of these new highs, as you can see through there, eventually the market gives way, and you see the selling at the end of the session with a 900 point drop. So we've got this sort of channel moving to the upside there, which would be more like that, where the market's broken out and then failed to hold. Struggled at the 200 MA twice, market came back to the 20-bar moving average, and then eventually prices drove through. Like I say, at the moment they want the market to be moving to the upside. There's no economic news today, and really the market doesn't need it at the moment. However, there are some figures that are worth looking at again, which I'll come to in just a moment. So on the overnight, we see prices gapping lower. We see them being bought back immediately. You can see the market opening there. Green bar, buying coming into the market. Prices retrace. Classic pattern from the Dow. And you can see it wending its way up through the 200 bar moving average and trading up towards the DP, which is no surprise whatsoever. That's where we're currently at. Watch this area in the pre-market session, see if prices struggle. If they do end up moving lower, watch the 200 bar moving average as prices come back, plus the 20 bar MA as well. In the implied volatility, we can see this has dropped on Friday. No surprise. Like I say, this really needs to pull back. The volatility aspect of the market, the options premiums, is too frothy at the moment, and this needs to pull back. And given what we're seeing here in the chart, we are going to get some sort of froth coming out of the market, as long as prices can be sustained to the upside, of course. On another note, unemployment figures and claims that we saw last week. So yesterday, Sunday, I decided to download all the data off the Fed's website and have a look at this in a bit more detail, because there is an expression: when America sneezes, everybody else catches flu, which is probably not the most appropriate phrase at the moment or saying, but that's a fact. And You're going to see why I'm saying this in just a second. So this data goes all the way back to 1967. It's the weekly initial claims for people that become unemployed or laid off. I've got a 200 bar moving average running through here, and you can see that through different periods of time where the jobless claims have increased, and the most recent being the 2008 crash. You've got the dot-com bubble there as well. So when prices get above the 200 MA, you see a spike in the unemployment. And we were starting to see this in the run into 2020. However, let me show you how bad this is, because, you know, everybody's heard it bandied about, and even I showed this in the market alert last week, but I thought I'd go back and have a look at it in more detail. When you hear the figure 3.28 million in 1 week, and when you actually look at this chart, you get a pretty good idea of how bad this really is. This is absolutely monstrous. This is 1% of the working population, or the one not working population of the population of the US that were laid off within 1 week. Now, the report's out today that this lockdown could last as long as 6 months. I'm hoping that's an element of hyperbole there, and it's not going to be the case. But to put this into some sort of perspective, you can see there 665,000 for the Great Recession, as it's called. And this is why I keep joined in with Gerald Salenti and co. of calling this the Greatest Depression, because that's what it's going to be. And this is only 1 week in to any sort of lockdown. This is going to increase each week for a while, then it will taper off, and then it will increase once more. But when you see it laid out like this, you get a really good idea of how bad things are as far as the economy is concerned. So I thought I'd just bring this one to your attention. And the other thing I wanted to mention as well, which I've sort of jumped around a bit here, which I should have come to first, was the Fed's balance sheet, which is, you can see there, is going parabolic. And this is going to continue, as this article here suggests, and I wouldn't disagree. 9 trillion. Former Fed strategist now expects that Fed's balance sheet to double this year, and I wouldn't disagree with this, where you will see this, as I say, a parabolic move to the upside, where the coronavirus will top out and then go over. This is going to remain parabolic, and this is more of a concern, and should be, to anybody than the coronavirus, because the global impact on the economy, people's livelihoods, jobs, is going to be far more impactful than the coronavirus. And I'm not trying to dismiss or diminish those who have passed away with the COVID-19 at all. I'm just making the point that as a tiny percentage of the world's demographic, and I mean very, very tiny, the impact on the economy and jobs is going to be the likes you have never seen before. And you're going to see the Fed buying absolutely everything and anything, including companies. Up until this point here, the Fed only had US treasuries. And then from 2008, they started to buy all of the toxic mortgages. And then through this, they were printing more treasuries and buying toxic companies' debt, corporate debt, all the way through till they tried to normalize with QT, quantitative tapering. This failed, and then in September the 18th, as you saw in the other videos, I said the 25th in there, I meant the 18th actually, when the repo market went pear-shaped. It didn't work. They had to come back to the market. They started printing 60 billion in treasury bills each month, saying it wasn't QE4. Well, we all know it was QE4, and now we're in full-blown QE5, which we'll look at in more detail going forward in the market alert. But this is a very interesting thing now, that the debt is going parabolic. And here you can see, this is before we got to the COVID issue, that global debt surged to a record 250 trillion in the first half of 2019, led by US and China. What a surprise. And when you see these key points here, this report released by the International Institute of Finance on Thursday showed that the global debt surged 7.5 trillion in the first 6 months of 2019. Well, look what it's doing already in 2020. Rising debt across the world has been a big concern for investors, and also been flagged as the next breaking point, interestingly enough, by a number of economists. and the IIF states that global debt will top 70 trillion in 2019, up from 65.7 trillion in 2018, driven higher by the surge by the US federal debt. So keep an eye on these two things, the weekly jobless claims, because it's going to have an impact as where this is concerned, because companies are going to have to be bailed out by the Federal Reserve. Okay, that will do it for this one. If there is anything else to report today, I will let you know. We'll have a look at crude oil tomorrow. That's also, from what I can gather, is falling through the floor, heading down towards the $20 per barrel level as well. So we'll take a look at that tomorrow. And like I say, that's it for this one. Thanks for watching. See you in the next one.